Simpson Manufacturing is not a flashy stock. It makes connectors, fasteners, anchors, and building products. Basically, small metal parts that hold homes together. But boring businesses can be powerful if the margins, balance sheet, and valuation line up. By the end of this video, you'll know the fair value range I'm watching, the housing cycle risk, and whether SSD belongs on a research list. This is not financial advice, it is a research breakdown. The short version is this: small metal parts, big margins, not exactly a bargain price. So what does Simpson Manufacturing exactly do? Simpson is best known through Simpson Strong Tie. The company sells structural connectors, truss plates, fasteners, anchors, adhesives, and other engineered building products. That sounds boring, but the value is reliability, code compliance, and stellar thrust, and distribution. This is why the stock is interesting. You're not betting on a hot app or a trend. You're studying a niche industrial business tied to homes, repair, remodel, commercial construction, and structural safety. So, what did the latest quarter show? Q1 2026 was solid. Revenue was $588 million, up 9.1% year over year. Operating income was $114.6 million, up 12%. Net income was $88.2 million, up 13.3%. Diluted EPS was $2.13, up 15.1%. The green number is operating margin. It improved to 19.5%. The red flag is gross margin, which fell to 45.2% from 46.5%, mainly from tariffs and higher material, labor, factory, and overhead costs. Free cash flow was positive at about $17.9 million, and the company repurchased $50 million of stock during the quarter. Management also reaffirmed 2026 operating margin guidance of 19.5% to 20.5%. That guidance is important because it tells us what the next quarter has to defend. So where does SSD score well? My FinanceToGo score is 7.2 out of 10. Profitability is the strongest part of the setup. A building products manufacturer producing around a 19.5% operating margin deserves respect. Cash flow and balance sheet are good, but not perfect. Growth is decent and momentum is solid after Q1. The valuation score is only 5 out of 10 because around $184 per share, SSD is already being valued like a quality company. That does not make it bad, it just means the margin of safety matters. So, what exactly is SSD worth? For valuation, I'm using a normalized earnings range, free cash flow cross-check, and a quality industrial multiple. My fair value range is $160 to $200. The buy zone discussion starts below roughly $150 to $160. At about $184, SSD sits inside the fair value range and not clearly below it. That means I like the business more than I like the price. If the stock pulled back or earnings power improved, the setup would get more interesting. Let's take a deeper look into the bull and the bear case. The bull case is very simple. Simpsons has a focused niche, strong brand trust with builders, high margins, and a durable role in construction safety. Repair, remodel, code requirements, and structural safety needs can support demand beyond just new housing starts. The bear case is that this is still a housing-linked industrial stock. If construction slows, if dealers reduce inventory, or if tariffs and material costs keep pressuring margins, earnings can disappoint. At a premium multiple, disappointment matters. So, what to watch next? The next quarter checklist is North America volume versus price contribution, gross margin versus the 45.2% operating margin versus the 19.5% to 20.5% guidance range, euro volume and operating income, free cash flow conversion, and buyback pace. The thesis breaks if operating margin falls below guidance. Revenue growth turns negative while the stock still carries a premium multiple. Gross margin pressure persists or free cash flow conversion weakens after CapEx normalizes. Let's take a deeper look into my final verdict. My FinanceToGo verdict is that it's a high quality cyclical stock which is worth researching, but I personally would wait for a better price. SSD goes on the high quality cyclical watches bucket. I like the business, I like the margins, I like the niche. I do not love paying a full price for housing linked business without a wider margin of safety. If you do want stock breakdowns that find quiet compounders without ignoring valuation, subscribe to FinanceToGo. Also, tell me in the comments, would you pay up for Simpson Manufacturing quality or wait for a better price? And again, this is educational content only, not financial advice.